Our second theme is on the Federal Reserve, and we want to remind investors that stop and go policy can go both ways. It doesn't mean that you stop and the next move is a cut. It actually can mean that it's a stop and the next move can be a hike. We are very concerned with our optimistic view on economic growth. Remember, it's a formula, but it also, all of these policies that we're seeing globally are inflationary. And we have seen an improvement in inflation from those multi-decade highs. But if you get a Federal Reserve that gets dovish or continues to cut rates at a time when inflation is not where they want it to be, plus you have all of this stimulus being thrown to the consumers here in the US and globally, as well as the continued investment in AI, how can you say that continues to be disinflationary? That is inflation. We are still looking at money supply that continues to grow in the low single digits on a year-over-year basis. We're looking at inflation still uncomfortably high, specifically in the service sector. And when economic growth accelerates and you have stimulative policies, this is inflationary. So we think this is going to cause some inflation scares this year. We think that the Federal Reserve will have to stay on hold regardless of who comes into that Fed chairman seat. We think that the headlines and the noise around the Fed chairman are unfounded. We believe strongly, as we mentioned in our recent white paper, that the Federal Reserve will remain independent. It's a committee, and when you look at the members that are voting this year, many of them sit in the hawkish category. So we don't really see any evidence that can suggest the Fed will continue cutting rates this year, and that's a contrarian view. Now, when it comes to the labor market, we do realize the labor market is cooling, but there are some major structural shifts in the labor market right now, whether it's from AI or it's immigration. We're looking at, in the first half of 25, about 1.5 million less net immigration to the U.S. So if this continues from the immigration standpoint, we can deliver less jobs on a monthly basis, somewhere in that 50 to 70,000 range, without a meaningful increase in the unemployment rate. So if you have the inflation risk that's overshadowing the cooling in the labor market, the Fed will quickly shift their tune, and you may see interest rate hikes in the second half of this year as opposed to the cuts that are priced in the market.